If you're seeing canceled policies, non-renewals, or steep costs of increases for property insurance, you're not alone. With the mounting challenges in the residential insurance market, particularly in areas affected by wildfires here, experts from the Office of Insurance Commissioners, the National Association of REALTORs, and the insurance industry will provide updates and answer questions today. We've got several topics that we're going to cover. Current trends in insurance cancellations and non-renewals, challenges for home buyers in securing new coverage, rising costs, and the impact of wildfire risks, and strategies for navigating these issues with clients. Let's get started with our first panelist, which is Kenton Brine. Kenton is the president for Northwest Insurance Council. Kenton brings 30 years of public policy communications, political engagement, and insurance advocacy to his role in the Northwest Insurance Council, which he joined as president in 2015. After volunteering to help in a state legislative contest in 1982, Kenton left his Central Washington roots for the state capitol in Olympia to work for the legislator, rising from the position of bill clerk to becoming Senate Communications Director over a 13-year career. He's owned by lobbying and public affairs firm. He's owned a public lobbying and public affairs firm, managed state political and ballot measure campaigns in Washington and Oregon, and directed policy advocacy programs for state and regional and national insurance organizations across the West for more than 20 years. We're a nonprofit, member-supported trade association dedicated to providing timely, accurate information about the property and casualty insurance to consumers, communities, and news media and public policy makers in Washington, Oregon, and Idaho. Kenton is the 2010 recipient of the President's Citation from the Professional Insurance Agents of Washington for his service and dedication to professional insurance agents and the insurance industry. Kenton makes his home in Olympia, Washington.
That's quite an introduction that I apparently wrote myself, so apologies for how long that took. I am pleased to be with you. Thank you so much to Bill Clark and the gang at the Washington Association of REALTORS. It's great to be with you. I know this is a challenging time for all of you all, just as it is for homeowners and insurance consumers in Washington and really across the West. I'm going to try and provide some background and context for why some of the things you're seeing are happening. And hopefully by the end of today's meeting, you'll have not just a better picture of why things are happening the way they are, but ways in which your industry and our industry are trying to make it better in the near term and the long term for insurance consumers and home buyers and sellers. First, a little bit about the Northwest Insurance Council. As stated previously, we're a nonprofit insurer-supported organization, and we work with media, consumers, organizations, and we speak to legislators and regulators in Washington, Oregon, and Idaho. The organization's been around since the 1960s. I have also been around since the 1960s, but I didn't start at the Northwest Insurance Council until 2015. So let's talk a little bit about the basics of insurance. I find that it's always helpful for people to have a little bit of context about what P&C is versus other kinds of insurance. And in particular, the role of Northwest Insurance Council is to speak with media, consumers, and public policymakers specifically about property and casualty insurance. And that is homeowners, renters, mobile home, condo, auto, RV, boat, motorcycle, personal umbrella insurance and liability insurance. And then there's business insurance. Today, we're talking about personal lines of property and casualty insurance. And I know we have David Fort on from the Office of the Insurance Commissioner, and he's going to talk more about their role. But insurance in particular is regulated by the states, not by the federal government. There is a role that the federal government plays, but largely the rules and laws that govern the sale and servicing of insurance policies is done by each state individually. Importantly, the personal lines rates and forms that insurers use in the market all have to be reviewed and approved by the Office of the Insurance Commissioner prior to use in the marketplace. So more basics here. The P&C insurance is the practice of predicting risk and pooling those risks, similar risks together and charging a premium for similarly situated risks in order to even out the cost for those who are paying for insurance. This is different than what a lot of people think insurance is, which is like you're paying for premiums and it's going into some kind of savings account that will help you pay in case of a loss. You're actually paying for current risks that are already, and losses that are ongoing as we speak, which is why as those losses increase for insurers, it affects the premiums that people pay. The big three elements of servicing and selling policies are underwriting, deciding who to write insurance for and what will be covered, rating what that policy will cost, and that's premiums, and then claims, taking care of the policyholder and rebuilding and replacing the covered loss after the loss occurs. A little bit more at 101 here. Homeowners insurance covers damage or loss to your home and its contents from theft, fire, wind, or other covered peril. It doesn't cover what it doesn't cover. Homeowners liability insurance covers accidents and injuries to others, and it can also cover the cost of living outside your home during repairs. Renters insurance covers damage or loss to your possessions inside the space that you're renting. It does not cover the building itself. That's the insurance that the landlord owns, takes care of that. That's why it's a much more affordable coverage, because it's just covering the things inside the place where you live. Also, obviously, your items with you wherever you are. So if you lose your laptop out of your car, it's stolen, that's going to be a homeowners or renters policy coverage and not your auto policy coverage. And then specifically not covered under homeowners and renters policy are flooding from outside the home, earthquakes, and earth movement. And that includes landslides, mud flow, and sinkholes. Those are separate policies typically available in the market. Can be harder to find in some places than others, but there's usually coverage available across the state for those. So what's going on today is, there's always been what I would consider traditional parcel level underwriting by insurers. And that, again, is how insurers decide what will be covered and whether or not they will write coverage for a particular property. And that's things that you would expect. The repair and replacement costs in that area, the likelihood of claims from the policyholder, the history of and risk of the insured structures on a property, crime statistics, flood and fire history, availability of materials and labor to make repairs after a loss. And then increasingly, there's been use of flood and hazard maps and/or risk scores, which are either generated by insurers themselves. For some of the larger insurers, they may do this on their own, but many insurers are turning to vendors like Verisk ISO to develop risk maps and risk models that help them determine how much risk they can take on in a particular area. And then there's what I call the big picture of underwriting, and that is what we're seeing more of today than in the past, where large losses that occur across the country are affecting the appetite for risk that insurers are willing to take on. So as we talk more about availability and affordability, I would say that this big picture underwriting is having an effect more on availability than it is on affordability, because as I noted earlier, rates and premiums are determined in part by a review by the Washington Insurance Commissioner's Office. And insurers can't use losses from California or Hawaii or New York in their rate making for Washington State. They have to have Washington specific data that Washington rates are based on. But what we are seeing is that companies are having to take a second look, a deeper dive on their overall risk profile and risk tolerance in order to remain profitable and not risk insolvency. So what are some of the changes and challenges that insurers are seeing that are affecting homeowners? In the past, in particular, as we look back the decade prior to and leading up to the pandemic, you see that basically homeowners and renters rates are relatively stable. You see a couple of years there, 2012, 2013, and then going up to 2021, where the percent change was above the national inflation rate. But for most of those years, it was either at or below the national inflation rate. Well, something began to happen in about 2021 as we came out of the pandemic, and we saw this during the pandemic, a big move to more rural areas and a more home building going on in rural areas that are more prone to natural disaster loss. In some states, like the Gulf Coast states, that's hurricanes and floods. In the western states, it's wildfire. So as those costs have increased and losses have increased, it's again had an effect that, it's had an impact that affects availability. And as you already know, homeowners insurance can be very difficult to obtain, particularly in central eastern Washington due to wildfire risk. Insurers are tightening their underwriting standards. I noted some of the questions that we received ahead of time involve like roofing materials and whether or not insurers are having people dropped coverage because they have a roof that has reached half its lifespan. I don't know specifically why that is, because it's going to vary from company to company what those underwriting standards are. But the bottom line is insurers are concerned not just about profitability, but about solvency. And they have to determine how much risk they can take on across the country when we're seeing an increase in these natural disasters. In some cases, of course, homeowners have been forced to combine multiple policies from different insurers to try and get an amount of coverage that protects their home. There are a lot of homes in Washington that are underinsured. We definitely saw that, as I'm sure David Fort can speak to, as a result of the wildfire last year in Spokane, the Spokane County area. A lot of those homes were dramatically underinsured. And then on the affordability side, we have seen premium increases that are much more dramatic than the last slide I showed you, more in the 22 to 36% range. And for some people, it's even doubled, particularly in those areas of the state that are more prone to a wildfire. So as I noted, we're seeing a dramatic increase in losses that are related to climate change and natural disasters, catastrophes, catastrophic events. As you can see in the 80s, there were roughly, on average, 3.3 per year, so 33 events over the decade, an average loss of $22 billion a year. If you look at what's happened just with hurricanes Helene and Milton, and this was an early estimate, this might have gone up by now, but we're in the $44 to $50 billion for those two hurricanes alone, and those are insured losses. Now, a lot of that is flood insurance, which is mostly a national program that's backed by the federal government, but there are private insurers that write flood coverage, and some of those losses will be borne by those companies as well. But it isn't just hurricanes, it's also wildfires, as you know. So at the same time, we have seen this increase in natural disasters, catastrophes. We've also seen a dramatic rise in the cost of rebuilding. The cost of labor and materials, as you can see in the chart on the right, the percent change from 1990. If you look at how exponentially dramatically that line goes up on the right side of the chart, you can see that beginning, again, as we came out of the pandemic, those costs got dramatically higher. This chart only goes through 2022, but I can tell you that those costs are continuing to rise and increase over time. And it's, I think on the local level, you know that it's difficult the cost is increasing, but also the availability of labor and materials, especially after a large scale loss, is dramatic. We had a major fires in Oregon in 2020, and there are still homes that are not rebuilt and claims are still open because 4 years later, it's still difficult to get homes rebuilt in that area, in those areas of Oregon. So the result obviously is unsustainable, and you look at what is happening or has happened in homeowners and commercial multi-peril, and you see the loss ratios. The loss ratio is a comparison of what an insurer is taking in premium versus what they're paying out in claims. And if you look at the last bar to the right, on the left side of the homeowners chart, I should say, the last bar on the right of the homeowners chart, you'll see that in 2023, insurers were paying out $1.12 in claims for every dollar they took in premium. And that's why insurers have had to go from level, steady, sort of inflation rate related premium increases to dramatic increases to catch up from those losses in the 2021 to 2023 period. So wind and hail are the biggest percentage of homeowners' claims, but they don't cost as much to repair part of a roof or replace a window as when you have a wildfire and you have to replace the entire home. You can see that fire and lightning are by far more expensive, average of $83,000 per claim compared to all the other losses. In fact, credit card and other theft, bodily injury, property damage, water and damage from freezing, wind and hail, those don't compare to the cost of wildfire claims when they occur. So the challenges for insurance companies are inflation, claims and repair costs, natural disasters, reinsurance. There was a period of time a couple of years ago where reinsurance, which is the insurance that insurance companies buy to protect their solvency after a major disaster, was as hard for insurers to get and as expensive to get as homeowners insurance is for homeowners at the local level. That market is now stabilizing, and that's good news for insurers. They're now able to get the level of reinsurance they need to guard against natural disasters. A lot of reinsurers have re-entered markets that they were not in for 1 or 2 years. It's still expensive for insurers to get, and they're getting less coverage for more money, basically. Higher premium for them to pay and less coverage for it. So they have to go out and patch together reinsurance from multiple reinsurers. Again, that market is improving, but insurers, when they have to pay higher costs for the insurance that they buy, that's going to trickle down to what it costs for homeowners insurance in Washington State. We talked previously about the cost for residential construction, but there are also things related to lawsuits. Nuclear verdicts have increased 27% over the last decade. Those are verdicts over $10 million. And of course, natural disasters are increasing as well, basically everywhere you look. I think one of the things insurers are concerned about is that we're sort of becoming the zoning police. So you think about Kittitas County and how difficult it's becoming to get insurance in that part of the state. That is largely due to the fact that despite these rise in natural disasters, people keep moving to these areas and are building homes in areas that are wildfire prone. And you can see the statistics there between 1900, the early part of the first half of the 1900s versus where we are today, where 55% of homes are being built where there's a wildfire threat. That affects what insurers look at when they're thinking about their risk tolerance. So from the perspective of insurers, we believe that there's legislation that can help protect consumers and improve resilience. And we're very interested in those bills. I just saw this morning a draft of legislation that's going to initiate, if passed. It was actually introduced last year and did not make it through the session, but it's being reintroduced by Representative Reeves. And it will have the Office of the Insurance Commissioner, the insurance industry, and the Department of Natural Resources working together on establishment of, verifiable mitigation efforts that homeowners can undertake. And along with that, there may be mitigation grants provided by the state to help people pay for home hardening and defensible space. We are going to have to build our way out of a crisis that we have largely created with the building that's gone on up to now. And that's going to take, I think, a cooperative effort between the insurance department, DNR, home builders, lenders, mortgage brokers, realtors, insurance companies, and all of us involved in this marketplace, because it's not going to get wetter, it's going to get drier. And fire seasons are going to get longer, not shorter. And we're going to have building and rebuilding that is more resilient to wildfire than what we've tried to do in the past. So we're all going to have to work on that together. We're going to have to continue investments in forest health and landscape mitigation, and there could be legislation coming also in 2025 to create a state insurance pool that will promote prescribed fire that helps with forest health. And in the event that a prescribed burn gets out of hand and burns private property, a state insurance pool could help repair or replace homes that are damaged in the event that occurs, because that's also a difficult market for insurers and for people who are engaging in prescribed fire to find the coverage they need in order to engage in those burns and protect against liability there. I want to mention briefly the Wildfire Prepared Home Program. This is the first time that the insurance industry has endorsed a specific program, although we have been active in FireWise over the years. This is a program that's backed by the IBHS, the Insurance Institute for Business and Home Safety, which is an industry-supported scientific research facility that has done, everything from crash test dummies in cars to doing wind, hail, hurricane, and now wildfire preparation. Homes that can achieve the Wildfire Prepared Home certification are much less likely to suffer significant damage in a wildfire. So once and I know that's been rolled out in Washington, but it is not widely used yet. And I can tell you not a single home has been saved by the Wildfire Prepared Home program yet in Washington, but we do hope that over time that will be the standard that homes are built to. It'll be part of the state's building code. And as homes are retrofitted, they can adhere to that as well. And that will start to build confidence in the insurance market that dramatic losses where entire communities are wiped out will eventually become a thing of the past. And you'll see insurance widely available the way it was 10 years ago. So as we think about realtors, and I want to stay in my lane and not assume I know how to sell real estate or how to help people buy homes. But I'm aware that the National Association of Realtors has a fire factor that can help you determine what wildfire risk looks like. The Washington Department of Natural Resources is developing a statewide hazard map, which I think will be similar to the one recently released in the state of Oregon. It's important to know, however, that insurers do not rely on either of those maps. They have their own that are developed either by individual companies or by vendors like Verisk. That inform their risk tolerance. And it's also important to know that if someone is either buying or selling a home, or they are in a home and they've been non-renewed, they do have an option to provide more information and challenge a risk score that an insurer has used. And I think we're going to see, as part of that legislation I mentioned previously, some efforts to improve transparency around the information that's provided to policyholders at renewal if their premium or a renewal is related to their wildfire risk. That's what Oregon has done. That's what California and Colorado are doing. And I think we're going to see something similar in Washington. And then, of course, as I mentioned, the Wildfire Prepared Home is the insurance industry standard for insurers writing homeowners coverage. And we hope that that takes a more solid hold in Washington over the next few years. So, and then finally, I think it's obvious that early interaction with insurance and financing are going to improve outcomes. It's going to be more important than ever that as you're working with homeowners, home buyers, and home sellers, that they're aware of the possibility that insurance might become a roadblock, an obstacle in a home sale. So the earlier they and you are looking for the insurance coverage that they need, being aware of the level of risk that that property has, the more likely you're going to have a better outcome for your client. Now, I think we're going to wait and answer questions at the end after other presentations are finished, but I want to thank you all for your time, and I look forward to trying to answer some of your questions directly. We'll also provide my email address if I can provide any additional information. Thanks very much for your time, and I'm going to pass it back to you.
That's a lot of information. Next up is Austin Perez. He is the Senior Policy Representative for the National Association of Realtors. In this role, Austin is the NAR's public policy expert on disaster and insurance matters, including flood and property mitigation and disclosure. He also is the staff director to NAR's Member Insurance Committee, which helps with the association's position on insurance and related public policies. Austin joined NAR in 2008 after advising on labor and immigration policies in the for the American Farm Bureau and the environmental issues for the U.S. Small Business Administration and the White House Office Management Budget. Take it away, Austin. Thank you.
Thank you very much. I appreciate it. Think you have a wonderful team here, members from the Washington Realtors. I want to thank Bill. I want to thank Kira. And I also want to thank Colette for the opportunity. Austin Perez, I represent the National Association of Realtors. I am NER's insurance expert and director to our member committee. And so I'm here today to provide a little bit of a national focus. NER's insurance committee has been discussing home and property insurance increasingly over the last few years. The members requested in Washington, D.C., this is a group of about 50 real estate professionals, realtors from across the country who know insurance issues. They requested an analysis. What if the federal government were to expand the National Flood Insurance Program to include earthquakes and hurricanes and wildfires and all natural disasters, not just floods, but all natural disasters? So I'm going to present the findings of that research today. I'm also going to walk through several options for you. I presented these options at NER's Insurance Committee last week, 2 weeks ago. We had our annual meeting in Boston at NER Next. It was a good meeting, a lot of healthy discussion and dialogue, and I'm looking forward to hearing your feedback. So I think the bottom line today is addressing home insurance in high risk areas is going to be a heavy lift in Washington, D.C. According to our actuarial research, creating a federal insurance program would require 98% of homeowners to pay more for their insurance so that 2% can pay less. I know that sounds bad, but there is a viable alternative. We can strengthen federal mitigation grant and loan programs to make safe homes affordable. The challenge is going to be securing the funding for these programs and reforms, which is going to require an expanded discussion from the membership, as well as a coordinated federal national advocacy campaign in order to do this. But first, let me, I guess, provide a little bit of what the problem is here. So everyone likes to put up on screen how natural disasters have been going up, the big exponential curve. I'd like to present the same chart, but in a different way. And I'm not going to limit myself to home insurance. I'm also going to talk about flood and earthquakes, because if we're going to talk about natural disasters, we need to be talking about more than just what's covered in a home insurance policy. Actually, let me back up first for a second here. There was a lot of information provided, a lot of great information provided from Kenton. Let me, I guess, start with what is insurance? Insurance is essentially an IOU for an insurance company to pay a large lump sum in exchange for smaller installment payments from the policyholder. Put another way, you're paying for your own risk, what you are expected to lose on your property from fires, floods, whatever. So there's an estimate of what you are expected to lose. So what the insurance company is doing is they're helping with your cash flow. They're not paying for your risk, you're paying for your risk, but they are holding that risk temporarily to pay out if there is a large loss in exchange for you making those payments over time. Some years you're going to have losses, other years you're not going to have losses. It's an expected loss. As it's not a piggy bank, it's not a bank account that money's being put into. It's expected losses based upon actuarial models. Unlike other industries, insurance companies are subject to something called statutory accounting. That means they have to prove to their regulator, their state regulator here in Washington State, that they can pay out all the losses on all of their contracts across all of the state all at one time. So they're on the hook for 100% of their contractual obligations. That's something that's different. In order to survive, they can't set prices. Their rates are subject to regulatory review in the state. How they survive in this kind of environment is to sell more policies and also to use other tools like risk tools, tools that hedge their risk, like catastrophe models, reinsurance, and bond investments. So if insurance companies are selling fewer policies in your area, it's not because they don't want to. In fact, that's their business model, to sell more policies. The problem is insurers must raise rates or reduce coverage if they can no longer manage their risk and face insolvency. All right. So I want to show you, I want to bring your attention to the top left corner. So this is Biltmore Village in Asheville, North Carolina, that you're looking at. And you can see on the bottom left, this town here that's flooded, severely flooded, is 2,500 feet above elevation. So this is the mountains where this flooding, where these entire communities have been washed away. So insurance companies looking to survive, they are literally running for the hills, and they can't even escape there now. They're taking losses in the mountains on flood risk. So it's tragically, whole communities are being washed away. All right. As a result, home insurance companies have been losing money for years. So Ken also showed a different version of the slide. This is from the Insurance Information Institute, gathered this information together. And again, combined ratios, this is a very important metric for insurance companies. So just so it's clear what this is, for every dollar is paid, and let's take 2023, for every dollar of premium from an insurance policy that's paid to the insurance company, they're paying $1.11 in terms of claims and expenses. So they are paying out more than they are bringing in. Think about your businesses, how long you would be able to stay in this market if you could not cover your expenses. You could not charge a normal rate of return, cover your expenses. So if you look more broadly, over the last 28 years, insurance companies, purely from their insurance underwriting, from their home insurance policies, have been losing in big. You can see a lot of red. There has only been 8 times in the last 28 years that insurance companies nationwide on average has actually made money on insurance policy. So how is this possible? How can they lose money on a product and stay in the market for so long? And the answer is they hedge their risk. They have bond investments. So they are big investors in real estate. So like they rely on that investment income to help the peaks and valleys of insurance. So this is one of the things that they've been leaning on, but you can see this pattern is not sustainable. All right, so what's the solution? So option number 1 is to let the states keep regulating insurance. This is the status quo. This is what's going on right now. What you have is on the left is the pros of continuing the status quo, continuing state-based regulations, which have been in effect since 1945, the McCarran-Ferguson Act, when Congress decided that this would be a state issue. Property and casualty is going to be regulated by the states. On the right, you're going to see the cons on this. So on the left, the pros. Historically, states have regulated home insurance. The main advantage of this approach is that states are better able, or perceived to be better able, better positioned to tailor the regulations to local needs and adapt to changing circumstances. Also, state regulators are often more responsive to consumers than elected officials 3,000 miles away in Washington, D.C. If you look at the rates, and I pulled some data here, again, from the Insurance Information Institute, you can see that under state-based regulation, yes, insurance premiums have been going up. Homeowners have been paying more for their insurance, but you can also see that it's pretty well in line with their income. So we need to be looking at relative. It's not that insurance rates are going up. Income is going up. The cost of everything is going up. The price of milk, energy, building supplies, everything is going up. So you do see that there is an increase in the amount of money. If you take a look on the right side, it's about 2% of median income is what the average rate increase has been from in the 2010s compared with before 1.5% of median income. And I don't have a chart here on inflation, but I can show you that, anyone who's interested afterwards. But here's the other thing that I think is very interesting about this. So you see in this chart, roughly average nationwide, you have 2% of income is going to insurance now, but you can see state by state by state. You can also see that Washington is one of the most affordable states in the country. That is thanks to your state insurance commissioner. It's also has to do with risk. It has to do with other things. But the point is that relative to other states, Washington's doing very well. I also want to point out here something, there's a lot of news around California insurance companies exiting California. Look where California is on this list. You would expect them to be on the right side with Texas, Mississippi, Louisiana, Florida, but they're right in the middle. I think the reason for that is because it's a relatively small part of California's markets that are being affected by wildfires as more development is occurring in the WUI and the wildland urban interface. But I think this is a very interesting chart. All right, so the downside. As more states are improving significant rate increases around the country, insurers are retreating from certain areas. There's also an increase in the number of policyholders that are moving to the state insurer of last resort or the FAIR plan. I saw a question about that. It's a very important question. Washington has a FAIR plan. It's a insurer of last resort. If you cannot find insurance in your voluntary market, you can go to a collection of insurance companies that offer an insurance of last resort. The problem is that if you look at the states with the largest FAIR plans, they're increasing. Why does this matter? This is a concern because even though most FAIR plans don't have an explicit state backing or guarantee, it's unlikely that any state or the federal government is going to let one of these programs go under if it's hit by the perfect storm and it's underwater. So FAIR plan growth is exposing consumers and taxpayers to more risk, and it's beginning to attract the attention of lawmakers in Washington, D.C. So that's option one. Option two, what if we were to create a national disaster insurance program, not just a flood program, a program for earthquakes, wildfires? I get a lot of questions on this. So we commissioned research. We hired actuaries in order to do an analysis of this. I can tell you I've read every bill that has been introduced in the United States Congress on this. Every bill in the last 30 years, and they've been dropped periodically for bills over the last 30 years. Every bill that's been dropped in the last 30 years that I've reviewed that's proposed a disaster insurance program like I'm describing does two things. One, it expands the federal mandatory purchase of insurance requirement. So everyone across the United States has to buy flood and earthquake insurance in addition to homeowners insurance. That's the first thing that they all do. The second thing that they do is that they require that the program charge full risk actuarial rates. So whatever they're charging, it's based upon the full cost of insuring that home, not a subsidized rate, the full cost of insuring the home. And it's to build up a fund large enough to start, any kind of a cross-subsidization scheme. So we hired actuaries to take a look at the costs and benefits of these programs, including an option that would expand the National Flood Insurance Program to include earthquakes and also charge a subsidized rate across the country. Here are the results. Even if you expand NFIP, the National Flood Insurance Program, to include all natural disasters across the country, most states will pay out more than they will receive in subsidies from states. You will be paying so that other states' risk is covered. Also, all 48 states will see a significant increase in their home insurance costs, even after you cross-subsidize the risk. Now, how is this possible that we can subsidize insurance and yet the costs still go up? It's because in order to make these programs work so that people in high fire, high flood, high-risk areas can pay less for insurance, everyone else across the country has to be forced to pay for it by adding on additional coverage on top of their home insurance for floods and earthquakes. Think about it this way. If you go to your home insurer today, you pick up the phone, you call State Farm or whoever, and you say, I want more coverage, your rates are going to go up. They're not going to go down. So if you add on top of your existing homeowners insurance for replacement costs, if you add on top of that flood and you add earthquake on top of that, it's going to be more expensive for people around the country. So even those that are steeply subsidized are still going to be paying more under an expanded national disaster insurance program than if you were to keep the current system as is. While these ideas would make some, home insurance more available and close the insurance gap for many natural disasters across the country, it also increase costs for most homeowners and encourage high-risk development. This mixed bag has prevented a congressional consensus from forming, which is needed to pass legislation like this. Politically, it's very difficult to pass legislation, which is why so many bills have been introduced and failed in the last 30 years. And in fact, in 2007 was the only time that the House of Representatives considered legislation like this on the floor of the House. It was called the Klein-Mahoney Bill. I started a year after this, so I had to understand this law, and it died a very quiet death in the Senate. So these are very difficult bills, and let me explain why. So a little bit of inside baseball. In order for Congress to consider an insurance bill of any sort, flood, terrorism, the leadership in both the House and the Senate generally ask their committees, their authorizing committees that are writing the bill, to, before they bring them a bill, to make sure that they have as close to consensus as possible. Insurance is very important for a small segment of Congress. And so the leadership is not going to put a bill on the floor that only a few members care about and spend weeks at a time trying to perfect the bill through amendments. So the leadership, Republicans, Democrats, both kinds of leadership, will ask the committees, bring us a bill that has 100% of your committee. Make sure you have everyone support it, and then we will put it under something called a suspension calendar in the House, which requires 2/3 to pass, or 60 votes in the Senate, at least, in order to bring it up for a vote. And most of these bills, you need 70, 80 votes out of 100 in the Senate in order to make this happen. So take two of the most stalwart champions on both sides, one on one party, one on the other. I picked two, and I put them up on screen, but you can pick any two stalwarts that you want representing, championing each side of the debate. Now, looking at these two folks, after you've passed a natural disaster insurance program that would increase home insurance costs for 98% of the population, do you see these two hugging it out? After you pass a bill like this, only to make it possible for more people to live in disaster-prone areas, do you see these two folks raising their glass, their champagne glass? Clink. This is what would be required in order to pass a bill like this. All right, option 3. So it's not all bad news. Option 3 is to strengthen existing programs that already exist to provide grants and low interest loans to homeowners in order to strengthen, harden, protect their homes. Building stronger and making homes more resilient against natural disasters is extremely popular and very bipartisan. Over the last 20 years, in fact, federal government has spent over $50 billion on community development block grants, BRIC, a program called BRIC, and other hazard mitigation grant programs. The advantage of this program, of these programs on the left again, is that they make safe homes affordable, which is consistent with NER's agenda to expand very tight housing inventories. Nevertheless, the challenge with these programs is that they require a lot of money, and it's not always a level playing field for disadvantaged or underserved communities. Not every community has the staff, resources, or know-how to compete for these federal grants, so we would need to ask for some reforms. Still, this is a much more viable option than asking Congress to expand the flood insurance program. They can't even keep the lights on the National Flood Insurance Program for more than 30 to 60 days at a time. To do this is going to be a lot easier than trying to expand that program to include wildfires, earthquakes, et cetera, even if you were willing to pay more for home insurance in order to subsidize other states. So let me end. We've got a lot of resources here that we've developed for you, including this National Disaster Insurance Program research. I will make sure a copy of these slides get to you. You can include these links. I really appreciate the opportunity to sort of share a little bit from what's going on in Washington, D.C. I want to thank you, members. I mean, we are very graced, very blessed to have members like you that enables us to represent your interests in Washington, D.C. And I look forward to your questions.
As always, very informative. I'm sure we've got lots of questions coming your way. I'm seeing them pour in, so hang tight. You're going to have some questions to answer for us. Thanks. Next up, we have David Fort. He is the Senior Policy Advisor, Property and Casualty Policy and Legislative Affairs Division, Washington State's Office of the Insurance Commissioner. David serves as the Insurance Commissioner's primary advisor on all issues related to the property and casualty insurance. He leads policy-related research analysis and writing in support of the development of the OIC policy positions and proposals in these focus areas. Prior to joining the OIC, David worked closely with the insurance companies and their insureds for over 8 years, adjusting large loss property claims in 8 Western U.S. states. His success in adjusting claims was assisted by his 15 years of experience in the construction field and 10 years in litigation support, including as an expert witness for the federal and state courts on claims handling regulations and how lenders should process borrowers' fire loss. David earned his undergraduate degree from WSU. David also has received his chartered property casualty underwriters and associates in claim professional designations from the American Institute of Chartered Property Casualty Underwriters. Thank you, David, for being here, and take it away.
Thanks, Colette. Appreciate that. And I'd like to thank the Washington Realtors Association for the opportunity to be here, and really thank all of you for taking the time to join us. So some of you might be wondering, what does the Office of the Insurance Commissioner do? So we are led by a statewide elected official, and you just voted for our new commissioner a couple weeks ago. Our current commissioner, Mike Kreidler, has led the agency for the past 24 years. Our upcoming insurance commissioner, Patty Kuderer, will be leading an agency of around 250 people. Important to know, the insurance commissioner isn't an insurance czar with unlimited power to control the insurance markets. The legislature provides the insurance commissioner with the authority on how to regulate the insurance market. So what do? We review insurers' proposed rates and form language to make sure it complies with Washington law. We answer questions and investigate problems for more than 120,000 consumers each year. We recover tens of millions of dollars a year for consumers with insurance disputes or delays. We license and audit the 34 domestic insurers based in Washington, and we monitor the other 2,700 that do business here. We license and monitor more than 200,000 individuals and businesses that sell insurance in Washington state, and we collect more than $1.6 billion a biennium in premium tax for the state's general operating budget. So I don't get the opportunity to present with Kenton or the insurance industry very much. So I think Kenton did a really good job talking about the market that we're in. And there are some things at the national and global level that we just can't have any effect on. But I want to talk a little bit about what's happening inside Washington state. So here are the past 6 years of homeowner claims paid out by insurance companies in Washington state. The cost of these claims, meaning the cost to repair the damaged property, has almost doubled. And why does that matter? It is because, as you've heard earlier today, insurance companies are required to charge rates that will collect enough money to pay future claims. Otherwise, they go insolvent and abandon the debts that are owed to their insureds with current claims. Important concept to note that companies normally don't file rate changes every year. Sometimes it can be 5 to 8 years in a stable market. Also, you should know that when insurers file for rate changes, they use historic claim data to try to project if they'll have enough funds to pay future losses. So as this cost increase was changing rapidly, insurance companies were collecting premiums with out-of-date projections. And you're going to see this here. And Kenton kind of had a slide talking about how stable the insurance market was for many, many years. And then, boom, we have this incredible increase in cost. So when an insurance company files for a rate change, they must submit statistical data justifying the increase. So if you look back here, when the data started to be available to them, that's when they were able to start making their rate requests. So we have a team of actuaries at the Office of the commissioner, and they will review these rate filings, and they challenge insurance companies' assumptions and often require further explanation or more data to support. And I can share that no one at the OIC can remember ever seeing anything like what's occurred in 2023 and this year. I want to highlight it's not because we have more claims being filed. This is not a claim frequency issue. The main issue for Washington is the continuing increase in claims costs. The cost of roofing, the cost of labor, the cost of drywall, the cost of concrete, the flooring, all of those things, we don't see that changing. So we don't see insurance prices going back to what they were 2 to 3 years ago. We do think it's stabilizing, and this pricing right now is likely our new reality. So just a little bit more background. So we review about 3,200 policy forms and about 1,600 rate filings a year. Sometimes a policy form filing can be just 1 to 2 pages if it's an endorsement or a notice or an application. If they're filing a whole policy, it can be 60 to 100 pages. For rate filings, though, it's really different. They can range from a few hundred to 5,000 to 6,000 pages. And as I mentioned, our actuaries review them to verify that the proposed rate changes are actuarially sound. And that means the rates must be set so that on average they equal various costs. And the primary cost is paying claims. But insurers must also justify overhead, commissions, fees, taxes, and profit provisions. We do require that profit provisions be reduced to account for investment income the insurer earns, and then the profit provision is typically a few percent of the premium. So an important thing to also know is I go back to say that the commissioner is not a czar and has unlimited power. When the data we receive justifies the request and rate change and the filing meets all Washington laws, the commissioner must approve the filing. There's no discretion. There's no ability to not approve it if it meets those 2 standards. So real quickly, not all types of insurance companies file rates. We have about 750 property and casualty companies that are what we call authorized or admitted companies. These folks are highly regulated. We have about 14% of the market. You may know them as surplus lines. We consider them our safety net. They take risks that the normal market won't take. And we do not review and approve those type of policy forms. And then there's a federal entity called risk retention groups that don't really play a role in what we're talking about today. So here is the standard. This is common language. I would say all 50 states have this in their code. This is what our actuaries, this is the basis of them being able to question assumptions from insurance companies. So we have to examine the filings to make sure that there's no profit gouging occurring, just as much as we have to make sure that they have enough funds available for future claims. And we also make sure, and what this unfairly discriminatory phrase means, when you have 2 equal risks, they have to be treated the same. So we also look at forms and rate filings to make sure that people of equal risk are being treated the same. So I've seen in chat, and we've been getting inquiries really wanting to focus on profit. And, I can't really speak to what occurs in other states, but in Washington state, because we have this prior approval process, not all states do. Some states have systems that are called file and use, where the insurance company files it, and as soon as they file it without review or approval, they can begin using the rates and forms. Some states don't have any. Wyoming doesn't have any type of a rate review process. But in Washington state, by law, we must approve it. And we actively look at the profit component, just as much as we look at operations and claims. quickly, there's a couple ways that companies can file profit loading. They can do a return on equity, an operating ratio, or a targeted rate of return. It gets complicated really quick. Actuarial science, not my thing, but our actuaries do review it. Basically, an insurer is allowed to show up to about 5% profit from underwriting and investments combined. Now, we got to remember this is prospective. So they may actually earn more or less in the following years. If you think about COVID summer of 2020 and no one's driving, auto insurers, they made good money that year. But just 2 years later, when they were bleeding money because the cost of claims had skyrocketed so much. So regarding solvency, which is a big consideration at the Office of the Insurance Commissioner, it's important for insurance companies to submit their rate filings for review and approval in a timely manner. Our current commissioner, Mike Kreidler, saw this hard market was going to be an issue many years ago. We requested the legislature to double our P&C actuarial staff, and we've additionally instituted some internal processes to help with efficiency. And we're also hold a webinar for insurance companies to teach them how to file better filings. All of these efforts has drastically reduced the time it takes for us to review and approve these filings. So, insurance companies just don't raise rates in these type of market conditions. They reduce or even stop offering coverages in certain areas. They'll seek to reduce their risk of claims costs by divesting its book of business to not have as many properties in a certain area. I kind of think of it as a bunch of card players around a table dropping cards they don't want in hopes of getting new cards for a better hand, or in this case, a better book of business. Right now, we're in an interesting situation. So if you look at the numbers across all of Washington State, we are not experiencing a dramatic increase in non-renewals and cancellations. So we have about 2.5 million policies. And last year we had 23,000 company-initiated non-renewals and 14,000 midterm cancellations. So 1% maybe. This is very similar to previous years. There really has been no change. But we hear everybody and their concerns. So we have conducted, we call it a data call. It's a request from information from insurance companies. And we're asking them exactly where are you non-renewing and canceling right now. And what we hope this is going to tell us is while our statewide aggregate numbers are kind of unchanging, what communities are getting most affected by this? So for any folks that have not been able to find insurance coverage in the normal market, the insurance commissioner created the Washington Fair Plan. And these are very basic plans that are good enough to satisfy lender requirements. They are not meant to be replacement to policies in regular markets. So as regulators, we often look at the state's fair plans as an indicator of the consumer's ability to ultimately find coverage. So an important concept to know is every insurance company has their own underwriting guidelines, meaning what they're willing to accept as a risk. They're all different. While many companies use wildfire risk scores, not all do, and they each take the number produced by this third-party proprietary program, data collection, and they apply their own standards to it. So right now we're finding as people are canceled and non-renewed, the market still has the capacity to move the policies around. And so there are companies that are increasing. Matter of fact, every year we have more policies in effect than the year before, just to due to construction and all that. So while they are able to shop around, and we recommend shopping around just for the fact that each insurance company is going to view your risk different than the other insurance company, we know that the cost is going to be more expensive. All of our cost is going up and up. And so even though we have very few folks on our FAIR plan, it's rising. And what we've been doing is we ask applicants, why are they coming to the FAIR plan? And over 50% of our applicants explains because they have too many claims to find coverage in the regular market. So only 12% of the applicants tell us it's due to wildfire risk. So you've kind of heard Kenton and Austin talk a little bit about mitigation. And I kind of think of it like this. So when we're talking about insurability, what an insurance company is willing to accept as risk, it's really the perception of that risk, or even maybe the actual risk, but it's really the perception of that risk. And when we're talking about the price of insurance, we're really talking about the cost of the claims. So community mitigation, very critical. Firewise, NFPA standards, they are doing a terrific job reducing fuel loads in communities and getting communities together to think about resilience. As Kenton mentioned, we are very excited about the Insurance Institute for Business and Home Safety's Wildfire Prepared Homes program. It is the very best mitigation science available for a homeowner to consider. There are some stats that are being developed as we have wildfires in the West. One of the stats is if a home is ignited, there's a 95% chance it's going to be a policy limit claim, totally destroyed. So ignition mitigation is the pathway for insurability, so the perception of risk. If you have a wildfire prepared home standard, which looks like this, the perception of your home's risk is going to be much different than the neighbor that does not have that standard. And in the long term, that's the key. If for folks living in high risk wildfire areas, if you're going to live there and if you're going to want insurance to be available for you, really recommend retrofitting if you're already there, or if it's a new build, instituting these type of building parameters. For new homes, this really isn't that much more expensive. It could be very expensive, though, to retrofit, right? If you have wood siding and to retrofit to non-combustible siding. Most everybody in Washington's got a Class A roof. We're pretty good there. There's going to need to be a little bit of change about landscaping. It's really important because of the ignition component that we don't have anything combustible within 5 feet of the house. That's hard for people to wrap their heads around. Also, wood fences not connecting to the house because the fire will just take that path right to the structure. So this is, we believe at the OIC, this is the future of insurability in high-risk areas. And so I'm happy to answer any questions.
At this point, I want to open it up to the panelists. So go ahead and log in, take a peek here. And if you guys have anything that you want to discuss, let's go for it. And then right after this, we will go ahead and open it up for Q&A.
So I guess I could throw out something in response to what David shared. A lot of great information there. Also, thank you, Austin, for your presentation. I wanted to mention the difference between the Firewise program and the Wildfire Prepared Home program, and why this is so much different, why this is groundbreaking, the Wildfire Prepared Home, because Firewise has been around for a long time, and it's a great program in the sense that it helps raise awareness at the community and individual parcel level for homeowners to become engaged in the work of doing defensible space work and home hardening. That's terrific. But it's a lot of people want to know, like, if they're in the Firewise program, shouldn't they get an insurance discount for that? And there are in particular, I want to note that the problem from the insurer perspective with Firewise is, and the key difference between it and the Wildfire Prepared Home program is, with Firewise, you are part of a community, and it's anticipated that when you sign up and become a part of that community, you're going to do certain things to mitigate your risk of loss in a wildfire. You're going to trim trees, you're going to remove trees from within 5 feet of your front door. You're going to get the screens that you should put over your vents to make sure embers can't enter. And you're going to do that, and not going to just do it once, but you're going to do it all the time. But there's no real follow-up to it. Like, there's no requirement that you do that every year, that every spring you go out and trim those same shrubs and bushes, and that you make sure that your roof is replaced. No one comes to check on it unless you ask for it. So the difference between that and wildfire prepared home is it's a bit more extensive, the things that you're required to do in order to meet the standard. And then you do have to follow up, and people will be checking to make sure that that work is done every year over time, so that your home remains a lower risk for wildfire. And then secondarily to that, there's interest in doing this kind of work on an individual parcel level. But the next step that's so critically important is, as we understand more about how fire moves through a community, we have to focus on retrofitting in the built community those homes that are most likely to go first and ignite the other homes around them. So that's where wildfire science is heading, and why it's so critically important that we engage in the work with Wildfire Prepared Home to begin that process, to get individual homes to do it, and do it in a way that prevents fire from spreading through a community the way it does today.
I agree with Ken, and I'm particularly excited about IBHS. And I guess taking a step back, I'm not sure that this is clear, but insurance companies are charging for your risk. So what are you expected to pay out to the insurance company? They're trying to cover their expenses. So the higher your fire risk, the higher your rate's going to be. So why we're talking about mitigation and mitigation grants, or trying to make it easier in order to mitigate your risk, is because when you mitigate your risk, you harden your home, defensible space around your house, non-combustible materials. That tells the insurance company that you're lower risk, so your rate is lowered. One other thing I guess I want to add on this too. So I think that there's a lot of misunderstanding about sort of the bigger risks like fire, flood, earthquake. So, think this is not like auto insurance. This is not like an auto risk. I mean, I drive to work every day. I've got a pretty good sense of what's the likelihood I'm going to get into a little fender bender or make a claim to my insurance company. And so it's relatively simple for me, not simple. It's easier for me to get a sense of, okay, if I'm paying $500, $1,000 per year for auto, is that a reasonable risk given how much I drive, what kind of area I drive in? That's very different than flood or fire risk. So these events that are occurring at a severity that occurs in a 1 in 100 a year, a 1 in a 500 year, a 1 in 1,000 year. California, I grew up in California. Campfire, these fires are burning so hot and so fast, they're jumping 8-lane highways. So no one is safe when one of these fires burn. Now, how do these things happen? What are the risks? I think part of the challenge is people can't get their arms around the idea of risks like this. So just because you haven't had a wildfire, just because you haven't flooded, doesn't mean that you're not at extreme risk for a fire or a flood. I mean, I just showed you flooding in the Blue Ridge Mountains, places that even FEMA, using an index of 24 different disaster risks, they basically said this was a climate haven. This area in Asheville, Biltmore Village, it was black. There was no risk there. It just flooded. I mean, literally whole communities are washed away in the mountains. This is Noah's Ark level flooding. Just because it hasn't happened doesn't mean it can't.
How about some of these Q&A questions? Let's start with this one. Is there some place we can research and provide our clients for research to find information to be proactive in mitigating risk?
Well, so just a reminder, real estate professionals, our attorneys always remind you to stick to your license in training. It's fair to say to a client, a consumer that comes to you who's concerned about fire risk or flood risk, I'm not a risk expert. I'm not a fire risk expert, but I can get you in contact so that you can answer questions on it. So having said that, There are a number of places where you can look. You can look on ner.realtor. We have a ton of resources, including on Fire Factor. Realtor.com was one of the first to put fire factors on home listings across the country. There are a lot of different places where you can get information. It was also referenced IBHS, the Institute of Building and Home Safety. They're another source of information. Firewise has been around for many years. So like there are a number of different places, and what we can do is if you're interested, we can get you a long list of who you got to call, who are the experts on fire risk. We can get you all that kind of information after this call. Just let me know.
I guess I'd only add that, as we've mentioned, that Wildfire Prepared Home has its own website. And if you want to find out more about what that program is and what it requires to reach that certification standard, and even if a homeowner doesn't want to do all the things to reach the standard, doing some of it is critically important as well. I think it starts, I've been told by people at IBHS is, if you can do nothing else, make sure you get the screens, covering the entrances to your, the soffit covers and all that stuff, so embers can't enter your home, because that's where it's embers that cause wildfire spread in built communities.
So next question, does Washington State allow for an insurer to use credit scores to calculate rates, and how much impact does it have on a premium?
Yeah, insurers can use credit scores in homeowner rate filings. It's hard to say. Each insurance company uses them differently, and not all insurance companies use them. So it's different for each company.
Is flood and fire insurance available for renters?
So renters insurance is going to cover fire, yes. I don't believe it's going to cover flood. And so that's a real vulnerable community for flood. The only folks that have really the ability to acquire flood coverage are property owners. We have a federal flood policy, FEMA's National Flood Insurance Program, but we also have an emerging private insurance market that offers better policies, better coverage than the feds do.
I've seen multiple questions that kind of all come together. Some asking about like knob and tube wiring, some asking about roofs, things like that. Is there something specific that there's a list that insurance companies can go down, and those are things that can affect and either raise or deny rates for?
So before the others add their thoughts here, people should know that in the state of Washington, the insurance commissioner does not review, has no authority to review underwriting guidelines. That's what we're talking about, the considerations that each individual insurance company considers. It's their own internal business decision for what risks they take, and the insurance commissioner does not have the legal authority to collect that.
From the insurer perspective, I'll just add that as David has pointed out, that it's a competitive market, and one of the reasons why why the statute is the way it is because insurers compete on how they underwrite as well as how they rate. And I would say that the specific questions about what's covered and what's not covered is going to vary from, pretty widely from company to company. So there isn't a list per se of, there's what you can anticipate. There's that list, which is that, certain perils are covered under most policies, but the specifics of what's covered and what insurers will, what the differences are between, whether this roof is insurable versus with this company, but not insurable with that company, is really going to vary widely. And that's why it's really important, I think, for consumers, especially, to understand that these companies are all quite different from each other, or can be. And it's important to work with a knowledgeable insurance producer. I know a lot of my member companies, or a few of my member companies, like State Farm, for example, only sell insurance through their own platforms and with their own agents. But a lot of insurers write through independent agents, and those independent agents might write for 6 or 8 or 10 companies. And it's important for consumers. And I would also say, to a certain degree, it's probably helpful for realtors who are working with consumers to build a stable of good, experienced insurance producers in your area. Because as this coverage is hard to find in the current market, you need someone who goes beyond the 5 companies that every insurance producer writes for. And you need to find people who have some of these other companies that maybe aren't household names that can help place coverage and have a broader array of coverages and underwriting standards so more people can find the insurance they need.
That's a really excellent point. I really want to reinforce that point with Kenton. If you don't have a short list of insurers that are your partners, your trusted partners on your team, talk to Ken after this call. I mean, literally to start getting a short list of insurance agents who can help you, that you've worked with, that you've had clients work with. Don't just rely on, someone out. Be ready with a list in case a consumer comes forward. And I think Ken can help, point you in the right direction.
Next one, why do insurance companies not allow higher deductibles? Say 5 or 10,000 deductible if it lowered their insurance points.
Well, I think they do. I think if you just got to go shop around. Some have flat dollar deductibles, a certain amount. Other companies have a percentage of your policy limit. So I would recommend shopping around. There are definitely companies that have high deductibles, and it would lower your premium cost at the risk of you are now absorbing more risk, because you're going to have to pay the first dollar up to whatever your deductible amount is.
As far as residential, why are insurance companies dropping mobile/manufactured homes, especially as the house gets closer to 20 years old?
So at the OIC, we're definitely seeing manufactured homes kind of as the tip of the spear, or the canary in the coal mine's a better analogy here for us. They are becoming the most difficult to insure. Why is that? Irregular construction. They are hard to repair. Their claims cost are going to be more towards the policy limit more often than a regular stick-built home. And we're seeing some insurers not want to carry that risk as much as they have in the past.
Mobile home insurance is a very different product from a homeowner's policy. A home tends to increase in value over time. Mobile homes do not. They tend to decrease in their value over time. So you still have to maintain a certain level on the policy. And if there is a loss, it's almost certainly going to be a total loss in a lot of circumstances. So there's always been, I think, I won't call it a specialty line, because there is a thing called specialty lines, right? But it's a narrower niche of a market. I think it always has been. And there are fewer insurers writing in that space than there used to be, because of the profitability and the risk of loss.
How much would the insurance increase for that 98% of a national disaster insurance program?
The average nationwide is about $800, but it would be much higher in some states than others. And I, of course, am going to provide the research so that you can go through it on your own. Let me pull up the number if others want to pull up the number for Washington State. It's going to take me a few minutes. Maybe come back to me.
How can the insurance companies provide a binder, and then after closing, they can drop it like 3 weeks later? How does that work?
Well, there's a period of time that an insurance company can cancel policies. Matter of fact, in Washington State, there's no law that prohibits an insurance company from canceling midterm. It is problematic. We would hope that insurance companies would do their underwriting before sending the binder instead of post-binder underwriting. And it would be better for realtors, the rest of the community, if that practice would stop. And I would hope that you guys are finding the companies that do and do not do this, so you can trust them a little bit more with their binders.
By the way, I did get the answer. So under this research, under a subsidized, so there's 2 ways to do this kind of program. There's the full risk rate, like everyone pays their full risk rate, or you have a cross subsidization. Everyone pays an average rate across the country. Some states pay more than others in order to cross subsidize. So today, average cost homeowners policy in Washington is roughly about $1,000. Under a subsidized, not a full risk rate, it would be higher. Under a subsidized, if you were to do a national disaster insurance program, the average home cost would go up to $2,400. So it would more than double. If you were to do a subsidized national disaster insurance program, that's the average cost would more than double in Washington state.
And let's do one more question, and then we're gonna have to wrap things up. And this may be Bill Clark jumping in. So if you guys can answer it, great. If not, hopefully Bill will. Would you support a bill that forces insurance companies to use the actual residential rating and prohibits the use of wildfire rating on dwellings?
I'm not sure what that means. I can't speak for the next insurance commissioner, but there was the bill that Kenton talked about last year that talked about grant funding, and then also had a requirement of insurance companies to disclose what the wildfire risk score was if somebody was canceled or non-renewed on that score. That seems like good transparency to me personally, that if there were ways that people could be better informed of their own risk and steps that they can take to improve it, I think it's for the benefit of all of us as property owners if we could identify where our riskier parts of our property risk are.
If I could answer that question as well, and let me just clarify. So I'm NER, I'm your representative in Washington, D.C. It's Washington State with its members that would make a decision on a bill like this. So I'm not going to attempt to make a suggestion about whether to support or oppose something like this. But I would add this consideration. Insurance companies, like any other business, have to cover their expenses. Wildfires, you cannot base it on history. You can't look back over the last 30 years in order to come up with an estimate of what it would take for an insurance company to cover or figure out what their costs are. They need to use catastrophe models. They can't do it on past data. They have to do it simulating events, hundreds of years of events in order to come up with this. So if you were, consideration, if you were to basically reject these catastrophe models, they call them risk scores or catastrophe models, there's different ways of calling them, different ways that you can label these things. What would happen is what's happening in California. California, you can't use catastrophe models. That's why the rates are skyrocketing in a few areas around the state. It's the reason why insurance companies are leaving those areas of the state, because they cannot cover their expenses, because they need catastrophe models in order to assess the full cost, what it's going to cost to cover their expenses in those high wildfire risk areas. So if you want to repeat what's going on in California, that would be the way to do it, is go down this road and basically prevent insurance companies from figuring out what their expenses are in high wildfire risk area.
Yeah, and just for clarification, because Austin's probably not familiar with Washington State, CAT modeling is allowed in rate making, and wildfire risk scores are allowed in underwriting. Wildfire risk scores are not used in rate making, but those are allowed. We were hoping that this bill would have more discussion because it was about the transparency of the score in the underwriting factor that we thought was beneficial.
You know, my assessment from talking to some other realtor associations around the country is kind of what Austin was getting at, that, you know, to the extent there are obligations placed on the insurance industry, then they'll make a business decision on do they stay in the state or not. So it's hard to answer that question, because it relates to one question I had maybe for Kenton, which is, to what extent will the underwriting include an in fact detailed review of what a homeowner may have done to fireproof their home, right? Like sometimes if you're relying on models, you may be in a high risk area, but the house itself could have had significant investments to make it fireproof on the siding, the roofing, the vents, vegetation removal, stuff like that. Does the coverage get to that granular level of like what improvements have in fact been done? Or is it more general that if you're in a high risk area, we're not going to look at what you've specifically done to that house?
So in the current marketplace, it's more the latter than the former. So insurance companies are using risk modeling and wildfire risk scores and mapping to determine their appetite for risk in broad areas of the state. But I've also seen personally, and have been a part of news stories about people who had their coverage non-renewed because of wildfire risk. And when they went to their insurance company and showed them their on-the-ground pictures and the things they had done to mitigate against that risk, that insurer reinstated the policy. So it's more of a, yes, they are in order to address their risk tolerance issues, doing this on a broad scale, but there is an opportunity for people to appeal those decisions when they occur.
Yeah, one thing I guess I would add on that, so catastrophe models, they are including sort of the latest information the insurance industry has on individual parcel properties. So, I mean, I had a situation in Colorado, a member came to me, she renovated her house, this $1 million house, renovated the house, significantly expanded the value of the house, did not tell her insurance company, burned down in a fire. And so the amount of coverage that she had was not sufficient in order to cover the full risk. So, one of the things I would encourage you to do is go home, take a look at your coverage, make sure that your coverage is based upon the latest information about your risk. It's really important. Also, one other thing too, we had CoreLogic come present at NER committee meeting a couple of years ago. You would be surprised how much information they can get now. Literally, they can detect if you have like the super duper advanced sub-zero freezers, because they're able to pull information for permitting. They're able to pull information from all kinds of different sources. CoreLogic is a big provider of data to the insurance industry. So if they don't know about it, tell them. You have nothing to hide. Share that with the insurance industry. If you need to adjust your coverages, please go ahead and do it, but don't wait until the fire happens and then find out you're underinsured. Be proactive about it and make sure you get that information to the company so they can accurately rate your risk.
Thank you, guys. Austin, David, Kenton, I can't thank you enough for being here. Bill, thank you for stepping in, and thanks to staff for organizing this and putting this all together. I just want to end on a little note so that it kind of gives people a little bit of an insight onto what else is going on behind the scenes here. As you know, Kittitas and Eastern Washington are seeing canceled policies, non-renewals, or steep cost increases for property insurance. Seattle King County Realtors will be producing a consumer-facing education campaign on the mounting challenges in the residential insurance market, particularly affected areas that are affected by wildfires. These shifts are impacting both current homeowners and new home buyers, posing a significant concern for real estate transactions across the state. This campaign is set to drop at the end of this month. We've already actually started some of it. SKCR has received a grant from the National Association of REALTORS to conduct a consumer outreach campaign to those realtors and homeowners within Kittitas County, aimed to position realtors as this resource should consumers experience challenges with homeowners insurance coverage. This will include trifold materials and communicating directly with consumers via postcards and digital ads in early December. So we've got a lot of stuff in the works. We're hoping that program will take off. It'll do good things here, and we'll be able to roll that out to the rest of the state over the course of the next few months through 2025. Thank you so much. We will continue to compile all these Q&A questions, and I'm sure there will be another round of insurance talk coming soon. Thank you so much, guys.